Chart patterns summarize market sentiment just like candle patterns, except on a larger scale. That means chart patterns represent collective market sentiment during a particular time period that leads to more favorable conditions for certain types of price behavior. This relates to the primary types of price movement with reversals and continuations. This is why chart patterns and candle patterns have similar or even the exact same pattern outlines. For bullish and bearish patterns, the main determining factor is the context pattern outlines are found in. Chart pattern effectiveness is determined by a combination of factors. First, there is clear price action in the pattern's development and high volume upon completion, if applicable, mainly for stock charts. Like candle patterns, there is a greater chance the pattern will succeed if it completes without delay. As seen in the case studies, patterns will generally succeed and have a more significant impact when they form with price action that is closer to theoretical diagrams, though there will usually be some variation such as asymmetry or swing points not being perfectly aligned. Chart patterns are also heavily influenced by the context they are found in. That is why past patterns, price levels, and ranges of significance need to be taken into account. This can be seen when bearish reversal patterns fail or produce a small drop during a stable uptrend. It can also be seen in cases such as the expanded boundaries of patterns due to clear resistance or support offered by influential ranges. In summary, a pattern is more likely to produce more drastic movement if it has a clear outline, a strong completion in terms of price action and volume, and less opposition. This means clear bullish patterns are likely to rise more when there is a lack of resistance, and bearish patterns are likely to drop more when support is weak or not present at all, such as in the case of dropping to new record lows. Like candle patterns and technical analysis in general, chart patterns are less effective when there are sharp fluctuations before, during, and or after their formation. Volatile periods represent uncertainty. Due to rapid changes in market sentiment, there are often drastic short-term changes in sentiment that can reduce the overall accuracy of medium to long-term sentiment represented by patterns. Rapid short-term shifts in sentiment can even negate patterns altogether. That is why volatile periods, especially near a pattern's completion, can lead to failed patterns or less significant results. Even if a pattern succeeds and has a significant impact, volatility can make it difficult to identify patterns and their potential effects, as seen in plenty of examples. Patterns are simply guides and they can still fail, even when conditions are favorable. This can often be attributed to exceptional circumstances, such as a stock market crash or events such as earnings reports, that can essentially negate the effects of chart patterns and general technical analysis.